Okay.
Okay, we're recording.
Oh, goodness. Now we're going to have to shape it up and clean it up.
Yeah. And that means one of us will get the recording and we'll make sure we get it out to those that are interested.
Well, if you are recording it, and I don't know if it goes to your laptop or to the cloud, if you've got that cloud function,
Gotcha.
I think it's going to be a lot easier than mine because I've had notorious problems.
Yep, I'll take it. You got it. So it's a couple of minutes after. Let's go ahead and get started. Welcome, everybody. Really appreciate you all joining us. We'll probably have some more pop on later. I'm Jim Cimino, Fidelity National Title. Tracey is the instructor today. You'll hear about him in just a minute. And Kara Goulet from Keller Williams Urban Elite, who is helping us host this today. And, you know, the only thing I'm going to say before I turn it over to Kara is probably most of you are familiar with Fidelity. I know some of you on the call use us. Those of you that don't, we would love an opportunity next time it presented itself to be one of your resources. So reach out to me or your sales rep. We might have a few other reps on the call as well. We'd love to help when we could be of value. I think you're going to enjoy this today. And before Tracey gets going, I'll let Kara pop in and say just a couple of things. But thanks again for joining us, folks. This will be recorded and we'll get it to you if you'd like.
Thank you, Jim. Appreciate it. So for those of you that don't know me, I'm Kara Goulet. I'm the team leader here at Keller Williams Realty Urban Elite in the Highlands. And we're really proud to bring this type of content to both our agents in the Market Center and outside agents, knowing that at Keller Williams and in general, we're looking to build agents that are building their own wealth from a lot of different aspects, right? So if that's helping our clients understand these exchanges and ourselves so that we can really build wealth around us, that is the goal of our Market Center. So that said, we have our annual event that is coming up this February. So it happens every year in February. And being that 2020 was a little bit of a wonky year, I think people are even more interested in what might happen in 2021. So as we do every year, we have a keynote speech by Gary Keller. And this year, I wanted to offer a quick opportunity for one of you guys out there with us today for me to reach into my digital hat and pull out one of your names so that you can join us for our annual conference this year. And then if anybody else wants to also explore that opportunity, I have included my phone number as my name here. So 720-220-4360. If you'd like an opportunity and you just didn't happen to win my little raffle, shoot me a text message and we'll see if we can get you hooked up. But I'm going to close my eyes here and reach into my digital hat. And I have selected Corrine, let's see, Corrine Larson. Corrine, you have won a ticket to our family reunion annual conference this year.
Well, thank you.
Wonderful. I'll get with you, Corrine, if you want to go ahead and shoot a text message to that number you see, and we can connect that way, and then we can get Tracey started here on the content of the day. Congratulations.
Thanks.
Kara, before you go away, if you don't mind just putting your contact information in the chat box for us, that would be great.
I will do that. Thanks, Jim.
You bet. All right, so with no further ado, Trace, we'll let you get going. Excited to hear about all this. It's all yours.
Thank you very much. And you can hear me. Give me a thumbs up or whatnot. I'm still admitting people as we speak. All right, thanks, folks. It would probably be best, since we have a relatively speaking large audience, to keep yourselves muted. If you want to ask a question, I don't mind. Unmute yourselves and feel free to interrupt. If instead you'd rather use the chat room, that's okay too. Just know that sometimes I can't see the chat room because my screen is filled with the PowerPoint that I'm about to use. So maybe Jim or Kara or somebody can sort of keep an eyeball.
We'll be glad to do that. Yep.
Thank you.
And we'll interrupt you if we think it's appropriate at the time. That'd be good.
Oh, interrupt me anytime. Danita does it all day long, so it's okay. All right, folks, let me do the share screen mode. And then I'm going to dive into first 1031 exchanges and then the proposed tax changes. So we will do that right here. Share. Okay, I need to admit another person. I'm going to drag this icon off to the side. There we go. And Jim, by any chance, I forgot to ask this question. Are you able to see people wanting to come in where you can admit them as well, or is it only me?
You know what? Let me look here. I should be able to, since you made me a co-host. And so if they're in, yeah, under participants, I can do that. I will watch that for you.
Well, you
Yep.
are just the best guy. I appreciate
Got
it.
it.
Okay, so here's some contact information. I'll just pause right here in case anybody ever wants to, contact us for any reason. So of course we do tax deferred 1031 exchanges, but we also, because of my accounting background, will help you or help the client figure out what their basis, their gains are. We can also discuss opportunity zones, which is a topic that really is not a qualified intermediary is necessary, but we do a lot of them. We also do or talk about charitable remainder trusts, DSTs, all that type of product. So if you ever have any questions about any tax type of situation, I will try and at least initially help. More so than a better answer is what I'll give you the right questions to ask or for your clients to ask to their financial advisor. All right, enough of that. Contact me anytime. My cell phone, which is right there, is on 24/7. So is Danita's. Also, that toll-free number, that 877-775-1031 number, you can call that number anytime during the business day, and you can either start an exchange immediately on the phone with them, or you can ask general 1031 exchange questions, or you can ask questions about a current ongoing 1031 exchange. All right, so I admit a couple of people, and all right, we're moving on. There we go. So already told you about unmuting yourself, ready to ask a question. I'm going to try and go a little bit faster here. This is where we're going to try and cut what we're going to try and cover today. 1031 rules, the safety and security of your funds, reverse exchanges, vacation homes and 1031s, and maybe even a tax-free exit strategy or two. All right, so just a little bit of advertisements. It's sort of like going to the movies, although probably nobody remembers what that's like now in the COVID lockdown. But there's some advertisements before the movie starts. The full name of our company is Investment Property Exchange Services, Inc. A big mouthful of a name like that. You can see why we're just changing it up to IPX 1031, which is also our website. We are a group of 33 of us now, attorneys and CPAs nationwide. We happen to be the largest qualified intermediary in the country. Just a little bit of bragging rights. Last year, we did almost $18 billion with a B of 1031 exchanges. The nearest competitor didn't even quite do 2 billion. In Colorado, continuing with my bragging just a little bit, and it only happens at year end when our managers and bosses have asked us to look at the numbers. Last year, we squeaked out almost, not quite, $600 million of 1031 exchanges for the Colorado, Wyoming, and Utah areas. We do all types of exchanges. The forward exchange, sometimes they're called delayed exchanges. The old-fashioned name is a starker exchange. We do reverse exchanges. We do exchanges for things other than real estate, like oil and gas and water rights, air rights, minerals, leases. We do build to suit exchanges where you want to do some construction or make some improvements to the potential replacement property. And I think everybody's aware, but just to make sure, personal property exchanges. We used to be able to do that. We used to be able to help a client that was selling their business and they would want to do an exchange on the assets of that business, cars and trucks and equipment and aircraft and planes and boats and livestock and franchises, and copyrights and patents and collectibles, intellectual property. Some of our largest clients were Amazon, Microsoft, etc. We can no longer do that. Personal property exchanges were removed, eliminated from the tax code with the Tax Cuts and Jobs Act starting 2018. So here's our website. I think it's a pretty dang good website. It's very user friendly. You can go to the resources tab. You can actually start an exchange online. If you don't want to talk to anybody, you can just do it online, fill it all out, and you can start an exchange. We have calculators that will figure out your 45 and 180 days, as well as calculating your capital gains. Although I need to be candid, I think that calling and talking to me, figuring out the basis of the gain, which only takes about 3 minutes, is probably more enlightening than just doing it using the calculator online. We also have what we call a knowledge center. It has every single exchange topic, a one-page answer that you can possibly think of. We also have, I think this is pretty cool. We have 1, maybe 2-minute videos on almost any 1031 topic, just teeny weeny little short videos. We also have brochures, all the reference materials, everything's right there. And we do webinars nationwide. We do one on the basics and one on more advanced topics. Again, nationwide, but they are not for CE credit. The stuff that I do when I do these Zoom things are for CE credit, but today's session is not. There is a backup of sorts, I guess, with the DORA and getting approval and et cetera. So no CE credit today. I think everybody knows that, but I want to make sure of it. So as a principal in the firm, or partner in the firm rather, I'm responsible for the states and the franchises of Wyoming, Colorado, and Utah. We are part of the Fidelity family. These are the title brands. The actual portfolio of title insurance carriers is right there. See, I muted myself accidentally by putting my elbow on my own mute button. And of course, IPX is a part of this big family. Okay, let's dive into it. 1031s, we're going to go, I think, pretty fast as we go through this because we do have, I think a majority of people are probably a lot more interested in the upcoming proposed tax changes than they are about 1031. So let me see how fast we can move through this and satisfy everybody. So section 1031 is just it's a tiny, only 2 pages out of the tax code to allow for what is called the non-recognition of gain. What in the world does that really mean? It means if you have somebody, a client that is selling a piece of property, and that property is an investment property, and they've got a gain, I don't know, let's make it up, 100,000, then that gain will be taxed at anywhere from 30 to as much as 40% in today's tax code environment. And that 30 to 40%, where in the world am I getting that from? Because if you know anything about capital gains are only 15 or 20%. Well, there's also the 25% for the recapture depreciation. There's also the 3.8% for the Affordable Care Act, affectionately known as Obamacare. And there's 4.63% that the state of Colorado likes to impose. That blended or effective rate is about 30, sometimes as bad as 40%. Okay, so again, 1031s are only for investment real property. I want to get the following out of our minds, push it out of the brain cells. So 1031s are not about, cannot be used to help defer the gains on the sale of someone's personal primary residence. There's already another part of the tax code, section 121, that lets you sell your home and you don't have to pay any capital gains. It's tax-free, far better than 1031, which is only tax deferred, as long as you've lived in your home at least 2 years out of the most recent 5 years. If you're single, the maximum exclusion is 250 grand. If you're married, filing joint, the maximum exclusion is 500,000. And by the way, sometimes people don't know this. You get to use that exclusion over and over and over as many times as you want, once every 2 years. So selling your home, the personal home exclusion, section 121, very good deal. By the way, that's not going to change as far as I know with any of the proposed changes to the tax code. So this should stay intact. But for the rest of our discussion in this first part of the Zoom presentation, we're going to focus only on investment property, not the sale of someone's home. And so therefore, we're talking about 1031s. And as long as you follow the rules, which we're going to march through ever so briefly, You identify property in the first 45 days and you close on the purchase of one or more of those properties within 180 days, then you will actually do the following. The gain will roll over. I love my own graphics. I want to see that again. So the gain gets deferred, it gets rolled over, it gets exchanged into the new replacement property or properties. You can buy, you can exchange into more than one. So both the gains and the taxes on those gains are deferred for the client. Okay, so accounting wise, we're going to, again, I need to pick up the speed just a little bit here. When you sell a piece of property, here's what it looks like accounting wise. We're not going to do debits and credits. We're going to make this, pictorial, so it easy to understand. You buy a investment property for 150,000. It goes up after you've been renting out for 2, 3, 7 years, whatever. It goes up to 200 grand. I know the numbers are not realistic in today's market, but it makes it conceptually easy to understand here. You bought it for 150, you sell it for 200. Gee whiz, ignoring commissions and closing costs, you're looking at a gain of $50,000. And when you do a 1031 exchange, the property you're selling is the relinquished property, and the property that you're going to buy, that you're going to exchange into, is the replacement property. You'll hear me sometimes, there's too many R's, and I usually start drinking by this time in the morning anyway, so I can't say relinquished and replacement fast enough. I may just call the relinquished property the old property, and I might call the replacement property the new property. They're not really old, not really new. It just makes the conversation a little bit easier. So again, when you do an exchange, that basis transfers into the new property, and so too does the gain. And that's the whole point of doing a 1031, because then you don't have to pay the 30 to 40% capital gains taxes on that 50 grand. Let's be a little more detailed, because that's really not the whole story. Again, we're going to buy a property for 100 grand, rent it out. 5 years later, you sell it for 150. The gain is $50,000. Almost everybody that you're going to be talking to as a client or a potential seller thinks that that is their capital gain. You now are going to learn something. You probably already know it. That is not the gain. Their gain is significantly more. Here's why. That original purchase price has been shrinking, sort of like a grape shriveling up into a raisin. In this example, that original purchase price of 100,000 has shrunk down now 5 years later to 82 grand. How's that happen? Well, what happens is the following. The purchase price, 100,000, is divided by the depreciation schedule. If it's residential, it's 27.5 years. If it was a commercial piece of real estate, the depreciation schedule is 39 years. So in this case, it's about $3,600 of depreciation each year. You rent it out for 5 years, so that's $18,000 total accumulated depreciation. That has to be subtracted from the original purchase price of 100,000. That gives you that adjusted basis of 82 grand. So in other words, when you're selling real estate, you have not one, but two capital gains. You've got the gain from the appreciation, 50,000, and you also have the gain from the depreciation recapture, 18,000. So how do the taxes look like on this? Total gain is 68 grand. I mean, that's significantly more than most people think when they're looking to sell their property. Well, the taxes on the appreciation is either going to be the 15 or 20% rate. The tax on the gain from recapture is always at a flat rate of 25%. Even if the client never took the depreciation, let's say it was a vacation home or second home, even if they never took it, the IRS will impute the depreciation and they will still tax them on that gain. If you find or have a client that's in that position, have them call me. I can help them. They could go back and restate their tax returns for the most recent 3 years. All right. Then on both of those gains, there's the Affordable Care Act, 3.8%. And then on the entire gain, the state of Colorado tax 4.63%. So what's the grand total? Grand total is 10 grand plus 4,500. I'm not going to read all that to you. The answer is it's 20-some thousand dollars in total taxes, which works out to be 29.8%. Well, that's close enough in my book to call it 30%. There seems to be some questions in the chat room. Maybe I'll look at them. Wow. Okay. Now, you know what? Those are old. It has nothing to do
Yeah,
with.
we're good. We're good, Trace.
Thank you. So in other words, Tracy, just stick to the show and don't do anything else. We're going to go back to the pretty pictures, and we're going to get, now that we know that there's two gains going on, here's what it really is. You buy a property for 150 grand, you rent it out several years, you sell it for 200,000. We all thought that the gain was 50 grand. No, there is actually two gains, and one of them is the 50,000 of appreciation, and the other part, the 25,000, is due to the unrecaptured depreciation. As you can see, they are taxed very differently. So when you do the exchange, the basis does indeed transfer, but now you know that there isn't one gain, but actually two that rolled over into the new replacement property. So that's it for accounting and 1031 stuff. Can you sell one property and exchange into multiple properties? You sure can. You can diversify. What about the other way? Can you sell multiple properties, mush them all together, and go buy one bigger, larger property? You sure can. That's a consolidation exchange. You can do any combination in 1031 land. Here are the 6 rules of doing a 1031 exchange. If you would be so kind as to shoot me an email after this, I will send this to you in email format. Actually, it's a little bit amplified even more from this with a better diagram even. And you can use that just for your own edification, or maybe use it in your marketing with your clients and prospects. All right, so here are the basics of doing a 1031. I always start on the left-hand side. That's the property you're selling, the relinquished property, the red monopoly house. And you're going to end up exchanging into the replacement property, the green monopoly house that's on the right. All right, so let's go and focus on the sale. There's your seller, there's the buyer, the qualified intermediary, that's us, IPX. We have to be assigned into that sales contract, and we have to have the docs, exchange docs prepared, and they have to be signed by the seller before the closing of the sale. So we have to be assigned into it. That speaking point is just what I just told you. We are assigned into the contract, and then the closing occurs, and the money cannot be touched by the seller. It has to be instead wired directly to us, IPX, and by law, we have to hold the net sales proceeds. Once we receive them, they are now called exchange proceeds. Okay, that starts the exchange. That's the legal date is the closing. So always think of a 1031 as going from closing of the sale to the closing of the purchase.
Tracy, we do have a couple of questions.
Yes, please. Yeah, fire them up.
Can we exchange livestock?
Not anymore. That's personal property.
Okay.
And it was even more difficult to do when it was, because sometimes, you know, if that livestock was headed to the slaughterhouse, it could be considered inventory. So, yeah.
Okay.
Another one.
The other one is, I think I know the answer to this. Can you sell investment property and buy other like-kind property?
Yes, and that's actually the very next slide. But let's tackle it now. Like-kind. These 1031s are called like-kind. What a horrible name. I think it's a big misnomer. Here's what it means. It means as long as you're selling real property, any type of real property, you know, you've held it for investment, used to produce income. Can't be your home. We already talked about that at the very beginning. As long as you sell any property, you can exchange into any other real property, except something you're going to live in, and it qualifies. So if you have a condo, you do not have to buy another condo. If you have raw land, you do not need to go buy more raw land. You can sell the condo and go exchange into a commercial office building or a fourplex or even raw land. Any property is like-kind to any other real property. Did that help? Okay. Any other questions, Jim? Okay.
The only other one is they were asking about a copy of the slides, one slide in particular. I'm guessing if they email you.
Oh, yeah.
Yeah.
I'll shoot it to them. You bet.
Great. There you go, Kelly.
All righty. So, okay, the sell side is done. It's over. The exchange has started. Now we're going to start focusing on the right-hand side, you know, looking at that new replacement property. You got 45 days just to identify. You're allowed a maximum of 3 properties to be identified. There is a way to identify more than 3, but a different set of rules kicks in, and I'm going to try and avoid going through all that in the interest of time. If you have questions about this, how to identify more than just 3, give me a call, shoot me an email, send me a text message, and we can go through that. Okay, so now the client who was a seller. Now they're acting as a buyer. They're going to close on the purchase of what will be their replacement property. That's when we again have to be assigned into the purchase contract. So you got to let us know who that next title company is that's going to be doing the purchase closing. Then we will prepare the exchange documents that have to be sent out yet again to the buyer, to the exchanger, have to be signed before the closing, and then we wire money to that purchase closing. You get all this done successfully in 180 days, voila, you don't have to pay taxes on the gains. The gains are deferred, no 30% tax. Questions? Because I need a drink.
Yes. Yep. Got some questions.
Fire away.
Can we, Chuck asks if he can go 50-50 on another property with somebody.
Yes. The
Okay.
devil's always in the details, so call me. Just don't assume something. It's a little bit different if there's LLCs involved or partnerships, but the basic answer is yes.
Okay. Is a second home considered an investment?
It can be. There are certain parameters.
Okay.
We may not get through them today. Give me a call and we will go through. It's not very complicated. There's 3 bullet points you got to pay attention to on a second home or vacation home, but it can be done.
Great. And for those that asked, I'll put Tracey's email in the chat box as well. That's
Well,
it for
thank you,
now.
Jim. Okay, thank you. Let's march on. What types of property qualify? We just talked about this. Any property out there that you can sell will probably qualify for 1031 treatment. Like kind, we said, hey, that's somewhat of a misnomer. You do not have to buy more land. If you sold land, you can actually do an exchange and buy commercial office. You can exchange into almost anything. I am telling you that real property is always like kind to any other real property, as long as it's in the United States. All right, so I'm going to skip this thing about long-term capital gains because it's more nuanced than we really need. So, except for one point, 2 points. People that are doing fix and flips usually cannot use 1031 exchange. Let's just, you buy some property, you buy a house, you buy a duplex, whatever. You spend 3, 4, or 5 months fixing it up and then you sell it. Guess what type of capital gain you've got on that fix and flip? It's short-term capital gains. It's income. They're not going to let you turn ordinary income into a deferred long-term capital gain just simply because you call me up and say, hey, Tracey, let's paper this one over and we'll call it a 1031 exchange. Fix and flips, generally speaking, cannot do or be handled as a 1031. That leads us to the following. Developers usually cannot sell their property and defer the gains under Section 1031. Again, for them, they're selling from inventory. They've developed something, they're holding it for resale. It is ordinary income. Okay, how am I doing time-wise? It's 11:30. I should probably max out here. So how long do you have to own the old property for it to qualify for 1031 purposes? There is no stated period of time in the tax code. I'm here to tell you from years of experience that at least a year and a day is a pretty good rule of thumb. What about the property that you buy that you exchange into? Again, there's nothing in the tax code that definitively states how long you have to own the new replacement property. But again, 1 year and a day is a very good rule of thumb for a variety of reasons. And you cannot live in that replacement property within the first year. All right, so this is exactly what I just told you, only written out instead of with pictures, more accounting. And if you don't mind, Jen, I'm going to blow through this slide because it's far too much for what we have to focus on in terms of the proposed tax changes. I probably should have covered this slide up. My apologies. This is important. And it is essentially rule number 4, if you want to take a look at that. You or your clients cannot do a 1031 exchange without a qualified intermediary. It is required in the tax code. And they cannot, the client cannot use their attorney or their accountant to do the exchange. They can certainly rely on their attorney for legal questions or rely on the accountant for accounting issues and questions and tax returns. But those, the CPA, the attorney, they cannot do the exchange. That also is prohibited. So they have to have someone like us. I'm going to tell you something that'll scare a few people out there. Unfortunately, we are not licensed. There are no federal regulators. There are no state regulators, not the controller of the currency, not the IRS. And in fact, we're allowed even to commingle funds. Our industry, the 1031 business, is a little bit like the wild, wild west. Here's just some examples of people that have stolen clients' monies and then gone bankrupt, and then the client can't finish their 1031 exchange. There's a notorious one here in Denver, Dan McCabe, who actually paid a $1.5 million fine, and he is unfortunately back in business. It just blows my mind. Doing exchanges as the ERG group. Another guy, he didn't actually steal any money, but he did go bankrupt, not once, but twice. And he is still out there peddling 1031s. Be very careful who you choose. These are just some of the bullet points that IPX does, because we're wholly owned by Fidelity with very deep pockets to protect you and your clients. We don't commingle the funds to move money at all for any purpose. It always requires 3 different signatures, including the client's, and we make verbal contact with the client always before any wiring of monies. And every single exchange we do is bonded. And in fact, we have a bond that no other company has. We guarantee the exchange up to $50 million. All right, so that's it for this 1031 stuff. I'm going to move to the proposed tax changes. Is that okay?
Yeah, quick question.
Yes, sir.
Somebody's asking if they can buy a home and lot from a builder that's not yet built as part of the exchange. In other words,
Yes, we
Okay.
would call that a new build, and you have to be able to have, I think, a high degree of confidence in that new build being done within your 180 days. So you might want to go shopping for a new build that's already coming out of the ground, so to speak. But I have completed exchanges, not very many, 4 or 5 and 20 some years, in which the project was not yet done, and yet we're still able to close on it. If you have any more questions in that regard, do give me a call. Any more
Okay.
questions?
that's it. There's just one about what you think Biden's going to do with the 1031 exchange program, but I'm sure you're going to touch on that.
Very much so. Here we go.
It's all
So,
yours.
Thank you, sir. So here are the proposed tax changes. Biden-Harris versus the current Tax Cuts and Jobs Act. Okay, so these are all the sources of my data. Not going to go through them all, just so you know where I get the data. These websites are also particular parts of the government, including the Biden and Democrat Party platforms and campaigns. Now, you'll note that a lot of this format may have the word Trump on it. I need to update it and simply call it TCJA, the Tax Cuts and Jobs Act. Let me tell you, let me describe this template that we're going to be using for the next 15 or so slides. The far left-hand column that's in black, those are the 6 major tax changes that we're going to focus on and talk about. The next column over, the first green column labeled Biden, that's what he has proposed. Then the last column is self-evident, Tax Cuts and Jobs Act, what it currently is right now. All right, so TCJA, just a brief history. It was passed late in December of 2017. It reduced taxes across the board for individuals. 85% of all taxpayers got a reduction in taxes. Corporate income taxes were reduced from 35 down to 21%. Personal property exchanges were eliminated. I already told you about that. The estate tax was reduced, and the exemption for the estate tax was actually increased, which is a good thing. You'll see that in just a moment. All right, so here's what is the philosophy, so to speak, behind the Biden-Harris's proposals. During the Democrat primaries, Senators Sanders and Warren actually wanted to have what is called, or what they called, a wealth tax. It would have been 2% on the gross wealth of anything above 50 million and a 6% wealth tax on anything above $1 billion. Biden says, no, don't want to do that, but we're going to do it the old-fashioned way. We're going to raise taxes. Raise taxes on what? Personal individual income taxes, corporate taxes, repeal or maybe just limit 1031s. They're going to raise capital gains taxes, and they're going to raise estate taxes. All in all, these proposed tax changes by the Biden-Harris administration are supposed to raise taxes by about $4.3 trillion. All right, let's take a closer look at all of these. Now, we we need to have the following in mind because almost everybody asks about this, and I want to try and give this a little bit of detail. So the Senate was previous to the runoffs in Georgia, the two Senate elections on January the 5th, 48-50. And of course, I think everybody knows that both of those seats went Democrat. Ossoff and Warnock are now the senators from Georgia. And now we have a split Senate, 50-50. The Vice President of the United States, Harris, will cast the deciding vote, but only in tie vote situations. She will act as president of the Senate, not as president pro tem. So with the Senate being at 50-50, if they use budget reconciliation, it would only take a few defecting Republicans to allow changes to the tax code. And in fact, if they do use reconciliation, they may not need any defecting Republicans to pass tax changes. They'll simply use the budget reconciliation method, which is a simple majority of 51. And of course, Harris would be casting that tie vote. All right. So in the current political environment, I think there's a very high likelihood that there's going to be significant changes to the tax code. The question is, how soon is this train coming at us? There are two schools of thought. That it will take most of the year for them to focus on this particular aspect, tax code changes, and they're allowed, you'll see in the next few slides, they're allowed up to 3 different types of budget reconciliations in any one calendar year for the Senate and the House. So they will probably use budget reconciliation, but probably not until the end of 2022, the end of 2021, which will make the tax changes effective in 2022. There are some people, however, that think that they'll be able to accelerate all of this and that they may make the changes in the tax code retroactive for the year 2021. I'm no longer in that camp. I think it'll take them most of 2021 to pass it, and that it will become effective in 2022. So that's my thoughts at the moment. I have a couple slides here explaining reconciliation. Again, it's being recorded so you can read about this. That's the explanation of how there can be possibly three different budget reconciliations in any one year, because they can pass one on spending, revenue, and the federal debt limit. That's enough of that. Let's talk about these changes. So far, am I doing okay? Is there any questions before I dive into this stuff? Going once, twice. Okay, here we go. 1031s. There are two completely different schools of thought, not because of what we think out here, but because of what Biden Harris have said, both on the campaign trail and as recently as last week after assuming office. They're either going to completely eliminate Section 1031 or they'll merely want to limit 1031 exchanges. All right, so what would that limit look like? If they limit 1031s, they will do the following, because this is what was on the party platform. Anybody who earns $400,000 or more would not be able to do a 1031 exchange. Those people earning 400 grand or less, they would still be able to do an exchange. This $400,000 number is not defined. Is that a married couple filing joint? Well, if that's the case, then that would mean a single tax filer would be at the threshold of just 200,000 being able to do a 1031. What about taxpayers that are in LLCs or partnerships, sub-S's, C corps, trusts? We just don't know. Is the 400,000 threshold based on last year's income or the current year? We just don't know. Okay, so that's 1031 exchanges. Let me fast forward to some information about 1031s. In 2016, that's the most recent data that we've got. So that, we don't have anything for 17, 18, 19, and last year, 2020. But in 2016, we did over 100, not we, us, IPX, but nationwide, all qualified intermediaries. There was over $100 billion done as 1031s. It is a huge, significant driver in the real estate industry. 1 out of every 5 residential sales are a 1031 exchange. 1 in 3 commercial real estate deals are driven by a 1031 exchange. When you start looking at deals that are bigger, about 30 million and above, this statistic of 1 in 3 actually becomes about 1 in 2 commercial real estate deals are being driven by a 1031 exchange. The University of Florida, along with Bloomberg, said that rents would need to increase anywhere from 8 to 13% to offset the effects of eliminating a Section 1031 exchange. Commercial real estate property values might decline anywhere from 8 to 12%. Okay, so I had some explanations in here about 1031s, but we are running notoriously short on time, so I'm going to skip this, and we're going to dive into the next topic, which is individual income tax rates. Again, there are two completely different courses of action that have been discussed and proposed by Biden-Harris, both on the campaign trail and even as currently as up until last week. They have talked about repealing all of the Tax Cuts and Jobs Act, or they have said they will only raise taxes on those people earning $400,000 or more. Pause for a second. They still have not defined that $400,000 threshold. Is it married? Is it single? What happens to corporations and taxes and small businesses? We don't know. If they only raise taxes on supposedly 400,000 people and above, that would mean that they would have to raise taxes on the top three brackets. The 32% bracket goes up to 33, 35% bracket they have said might stay the same, and the top bracket goes up to 39.6. I'm going to call that 40% if it's all right with you. So for Colorado residents, the top marginal tax rate, when you include state and federal, would be greater than 44%. When you look at people, individual filing income taxes in high tax states like California or Hawaii or Iowa or New Jersey, their combined income tax rates could be greater than 60% of their income. Okay, so the latest from the Biden-Harris administration says that they will reintroduce the ability to itemize as long as you're in the 28% tax bracket or less. But what about the standard deduction that was doubled under the Tax Cuts and Jobs Act? No, I have no idea. They've not said one way or another. Several different analyses using dynamic cash flow analysis have said that raising the marginal tax rates on the top three brackets would reduce GDP by about 1.5%, resulting in job losses of greater than 500,000. And the question becomes, well, why does that happen? Wealthier individuals who own businesses, big businesses, little businesses, medium-sized businesses, would reduce their hiring, pass along the increased costs of the taxes, expand their businesses less, resulting in a contracting GDP and resultant job losses. So it's a trade-off. If you want more money, you raise taxes, and maybe you want to spend it more on programs and new spending, but at the same time, it can act as a deterrent to growing GDP in the economy. Here's just one interesting aspect. One of the mantras behind raising taxes on those people supposedly earning 400,000 or more, I say supposedly because again, a $400,000 threshold is not defined. Do the rich pay their fair share? Well, I think we need to define who's rich and what is fair. So let's just take a look here. The income group is across the top there. And then the next line down shows the share of the income that each category earns. Then the bottom shows how each category, how much they pay in taxes. So if you define rich as anybody earning 400,000 above, 200,000 if they're single, those folks actually, if they raise taxes on them, earn 30% of the income, but they already pay 60% of all the taxes. Is that fair? So, okay, that decision making probably was done and over back on November the 3rd. So we've talked about 1031s, we've talked about raising the individual income tax rate. Let's talk about long-term capital gains. So this is where it's going to get a little bit difficult, and hopefully I don't want to lose you, so I'm going to slow down a little bit here. Here's the concept that Biden-Harris wanting to raise long-term capital gains. They currently, the top capital gains rate is 20%. They want to raise it to ordinary income, which currently would be 14%. Although if they raise the top marginal tax rate, it could be much higher than just 40%. They would only do that supposedly on those people making more than $1 million. Those that earn above 400,000 but less than $1 million would continue to pay capital gains at the current 20% rate. That's at least the current literature that we have so far. Again, all this is subject to change as it winds its way through Congress. Just as a small little reminder, when you sell investment real estate, the capital gains rate is not that 20% number. As we went through in the previous slides on 1031s, you can see that it's actually 30% when you sell real estate. It's either 15 or 20% on the appreciation, 25% on the recapture of depreciation, the Affordable Care Act of 3.8, state of Colorado, so that the total blended rate is 30-some% when you're talking about the capital gains on real estate. Okay, let's take a deeper dive. I think that given the current proposals, they will end up creating a 4-tiered capital gains system. I'm going to walk through this verbally, points 1, 2, 3, and 4, and then I'll show you a spreadsheet that has the same type of information, only it's in a spreadsheet. So here we go. Anybody that makes $0 to $80,000, the capital gains is currently today 0. So let me just take a little sidebar on that one. When somebody calls me up, I usually don't ask them what their adjusted gross income, but if it comes up in the conversation, maybe they say, oh, my CPA has said that I may not need to do an exchange because I don't earn enough money. My capital gains would be 0 because I only make, I'm going to make this up, I only make $70,000. You need to be careful. If they're selling a piece of property that's got, let's make this up, $50,000 of gain, and they don't do the 1031 exchange, they have to then add the gain to their income. Now, they're not going to be taxed on the first 10,000 of that gain because up to 80 grand capital gains are 0, but the remaining 30,000, did I do the math right? Remaining 40,000 of 50 grand of gain would get taxed, and it would be at that 30% rate. All right, so again, we're just trying to go through what the proposals are. 0 to 80, 0% capital gains. Those people, bullet point number 2, those people that are earning 80,000 up to 400 grand, capital gains are at that 15% for the federal, 5% if you're in Colorado at the state level, making it cap gains in the red of 20%. And yes, they would still be able to use a 1031 exchange because they're below that undefined threshold of 400,000. Bullet point number 3, anybody earning 400,000 up to $1 million, the capital gains would effectively be 30%, as you can see in the red. Where is that coming from? And again, we're not talking about selling real estate here. We're talking about regular old capital gains on stocks, bonds, mutual funds. It's because capital gains are the 20% at the federal level and 5% plus higher income people will now be exposed to the ACA tax 3.8%. So that's what'll be people selling stocks, bonds, whatever at 30%. But remember, if they're selling real estate, 2 things happen. That becomes 30 to 40% if they're selling investment real estate because you got to put in the recapture and depreciation. And they would not be able to do a 1031 exchange. They would end up paying taxes 30 to 40% capital gains if they're in this income bracket. Bullet point number 4. Those people that earn $1 million or more, capital gains would be essentially about 50-some%. 40% federal. Whoa, wait a minute. Where'd that 40% federal come from? It's because of this. The 20% federal capital gains turns into ordinary income. And if they raise the highest tax bracket, actually they raise the highest 2 brackets, then this 40% number could be considerably higher. All right, but again, if the taxpayer is selling investment real estate, cap gains would not be the 50-some%, it'd be closer to 55 to 65% because you have to include that depreciation recapture. And there is no 1031 option available. Sellers of investment real estate would end up paying somewhere between 50 to 60, maybe as bad as 65% capital gains. All right, we went through 4 different tiers of how capital gains would act. Here is the same information in spreadsheet format. Let me explain this just a little bit. Go to the far left-hand side where it says long-term capital gains tax rate. Again, you see 0, 15, and 20. That's what it is right now. That's what the Tax Cuts and Jobs Act did. Then the very bottom number in red, ordinary income. In other words, for people $1 million and up, the next 2 columns, you see income single, income married by a joint, $1 million and up, capital gains becomes ordinary income. We think it'll be some 40%. But if they raise that top marginal bracket, I don't know, let's make it up. Let's say they raise it to 45%. Okay, guess what? Capital gains is not 40, becomes ordinary income, it's taxed at 45%. All right, let's keep going. I want you to take a look at the 4th column. It's labeled at the top, ACA. That's the Affordable Care Act, 3.8%, how it gets applied. Next column over, state income tax rate. There's Colorado, 4.63. So that the next column labeled combined capital gains tax rate. These are the capital gains tax rates on selling stocks, bonds, and mutual funds. Be 0 or 20 or 30 or almost 50%. If you're selling real estate, go to the next column. It's labeled unrecaptured depreciation. It's taxed at 25%, has to be added to it so that the combined, next column over, combined blended capital gains tax rate for the sale of real estate, you can see that it goes up dramatically. To 15%, it becomes 30, 20% becomes 35, and then it becomes 50 to as much as 65%. The furthest column to the right, can you do a 1031 exchange? First, it may not be necessary. Down one, it says if you're less than 400,000, 1031s are available, greater than that, not. And then no exchange for the last 2 brackets. Okay, so let me just pause here. Are there questions, at least at this stage of the presentation?
Tracy, there was one question, and then we can open it up for everybody.
There's 3 more topics to cover, so we'll take this one and we'll hit it.
Okay,
briefly.
cool. Just a question from David that says asking what your thoughts are on big changes with some Democrats coming from notoriously conservative states, along with the midterms coming up in 2022.
That's more political than I probably should be going.
Okay.
Try and give an objective prognostication. It may serve, that type of thinking may serve to stall a Democrat senator from raising taxes. And I just don't know if it's going to be enough to stall this off.
Okay.
I don't think so. I guess I'm a little bit more pessimistic, but okay. So
There's one other one. Well, he sent it to you too, so go ahead. If we have time, we'll ask it later.
no, go ahead, fire it off right now. I don't see it, so you can tell me what it is.
So Brad's under the impression that 25% depreciation recapture is only charged against what was depreciated. So
Correct.
the same dollar wouldn't be charged recapture and capital gains. One or the other?
No, that's not correct.
Okay.
So again, you buy a piece of property for 100 grand, and making it real simple, and the property goes up to 125,000. Well, okay, the gain due to appreciation is 25,000 in my example. But over the years that you've owned it, if you own it 7 years, you own it 10 years, that original $100,000 number shrinks down to, I don't know, let's make it up, $60,000. That's the adjusted basis. So now there's still that gain from appreciation, 25 grand, but you now also have a separate capital gain, the unrecaptured depreciation, which in this Mike story is $40,000. That portion, 40 grand, is taxed at 25%. The appreciation is taxed at 15 or 20%. Both get hit with the Affordable Care Act. Both get hit with the state of Colorado. So in fact, I'm sort of explaining the slide that we're on. I can't believe my luck. When you pay taxes, you're going to look at that 40% maximum capital gains rate plus the unrecaptured plus ACA plus Colorado, so that the total or blended or effective rate is probably going to be well north of 50%. Did that satisfy whoever's question that was? I don't want to spend any more time on it, but I want to make sure that was clear.
We'll let Brad follow up with you. Sounds good to me.
Okay.
Thank you.
All right, sir. Thank you, Jim. Okay, so we're marching on. Here we go. The estate tax. So when a person dies, there is a tax levied on everything that they own. This is not capital gains tax. This has nothing to do with the step up in basis. This is just everything you own, all your cars, your house, your baseball card collection, your stocks, your bonds, your real estate, everything you own, your estate. If you die, currently under the new Tax Cuts and Job Act, if you die and your estate is valued $11 million or less as an individual, then you don't have to pay any estate tax. Yay. By the way, under Trump, the Tax Cuts and Jobs Act kept the estate tax the same as it was under Obama, which was 40%. So in other words, if you die and your estate is worth more than $11 million as an individual, then I don't know, let's make it up. Your estate is worth $15 million. Well, the first 11 million, no tax, but the remaining 4 million would be taxed then at that 40% estate tax. All right, so Biden-Harris wants to drop that $11 million exemption down to just $3.5 million. And oh, by the way, they also want to increase the tax from 40 to 45%. Okay, I think that's it on estate taxes. Let's go take a look at the step up in basis. Again, I'm going a little bit fast because we're getting towards the top of the hour. To me, this is probably the worst proposed change in the tax code. Worse than 1031s, and heck, that's my job. Worse than the estate tax, or worse than capital gains. Here's what happens. The step up in basis, section 1014, has been in the tax code since about 1916. And here's why it's been in the tax code. Because when mom and dad die and they pass the farm or the ranch or the small business to the kids, if there is no step up in basis, then the kids end up having to sell the business, sell the farm, simply to pay the capital gains. So here's what happens with a step up in basis. When mom and dad die, then the property, let's talk real estate, because that's what we're all concerned with. The real estate goes to the kids, and the kids have two choices. See the bubble here, we're looking at choice number one and choice number two. The kids can say, heck, we don't want to own real estate, we're going to sell it. Or we don't want to own the farm, we're going to sell it. They will pay no capital gains taxes because the basis has stepped up to fair market value on the date of mom and dad's death. Or the kids could say, hey, we're going to hold on to it. We're going to rent it out. We're going to continue to run the business. We're going to continue to farm or whatever. And later on, when they sell it, 2, 3, 5, 10 years later, whatever, then they will only pay capital gains on the amount of time that they owned it. Again, the previous gains from mom and dad were erased. They were wiped out on the date of their passing. Under the Biden-Harris administration, the following is what they want to do. When mom and dad pass away and the kids get the fourplex or the real estate or the farm or the ranch or the business, whatever, and whether the kids sell it or not, capital gains must be paid. In other words, they are proposing a capital gains tax on unrealized gains. What this means is the following. The kids, or whoever the heirs are, may not be able to afford to pay the capital gains, and they will probably be forced to sell the business or the farm or the ranch simply to pay for the capital gains taxes. This was, again, the reason that the step up in basis was put into the tax code nearly 100 years ago, to help families from being forced to sell the business or the property simply because mom and dad passed away. All right, step up in basis. I'm going to head to corporate income tax, and then we'll take some questions. So before 2017 and the TCJA, corporate income tax rates were at 35%. Legislation brought that down to 21%. Biden-Harris want to raise it from 21 up to 28%. Let's take a close look here. Here are some, randomly selected countries and what their corporate income tax rates are. Again, to be clear, you and I pay individual income taxes. but corporations also pay an income tax. And for various countries like Ireland, it was 12.5%, United Kingdom, 21%, etc. United States was at 39.1%. The top corporate rate was 35, but when you include state and other taxes, that combined rate was over 39%. That's a huge disincentive for a corporation to decide to locate here. They'd rather relocate somewhere else. That's what the inversions were all about. That reduced investment in America, cost American workers their jobs and potentially higher wages. So what Trump proposed when he took office was to drop it to 15%. As it wound its way through Congress, they said 20%. And in the 11th hour, literally within the last 30 minutes before the legislation was passed, the Democrats forced it to 21%. Okay, so that's what it's been now for the last 3 years, 2018, 19, and 20. The corporate income tax rate is 21%, which, by the way, now makes us more competitive. You can see that OECD average, the Organization for Economic Cooperation and Development. That's a group of the top 43 developed countries and what their corporate income tax rates are. But instead, Biden-Harris would like to raise it from 21 up to 28%. Don't forget state and local taxes. That makes it effectively 32%, which means that we would once again be higher than China, United Kingdom, Germany, Mexico, or Japan. Again, making locating the US as a corporation less attractive. So that's that proposal. Okay, so this is everything we just talked about in simple bullet point format. Don't want to read it to you. There are a couple other things that we need to mention and then we'll be done. One is state and local taxes. So property taxes, local income taxes, sales tax. It was capped at 10 grand under the TCJA. Any combination of, that a taxpayer would want, when they pay their property taxes or the local income tax or sales tax, could be used to reach their $10,000 cap. What capping this deduction did was to stop citizens that are in low tax states from essentially supporting people that are in high tax states. Let me show you a map. Take a look at the blue or the light blue. Those are counties actually that are in relatively low tax states. Before this cap on the SALT deduction, they were essentially subsidizing the people that live in the high tax counties that are in the pink and red. Biden wants to do away with this cap so that once again, people that are living in the blue would be helping subsidize income tax wise the folks that are living in the pink and red. Okay, so we've talked about all 6 of these items. This is the last slide. Joe Biden, Harris are proposing what would be the largest permanent tax increase since World War II. And here's what they want to spend it on. Again, none of the tax increases are going to be used to reduce the federal debt. Instead, it's going to be used to fund approximately $11 trillion in new spending programs, 1.4 trillion on the Affordable Care Act, reducing Medicare eligibility age from 65 down to 60. It's about 300 billion. Climate infrastructure, Green New Deal, approximately 2 trillion. Social Security, 1 trillion. College, K-12, this is the student loan debt, 1.5 trillion, etc. So the question then resides, and this is, we are now done. Can we afford these new taxes when we already have $24 trillion in federal debt, plus another new $11 trillion in spending? And do we want to raise taxes in the middle of a pandemic recession? That is it. How'd we do time-wise? We're just over, I got 5 minutes past the top of the hour.
That was a lot of information. Tracey, I really like your slides, man. You are the master when it comes to that. We do have a question. We can let people, let me ask the one that's in the chat box and then you can open it up. And Tracey,
Sure.
did you say you'll be sticking around another hour and a half to answer questions? No, I'm just kidding about
On the
that.
phone, maybe. How about that?
Debbie wants to know how a family will know what the parents' cost basis was on a home in
Sort of the
Biden's
same way that Right. Sort of the same way that it is today. If mom and dad die, how do you know what the basis is to make sure you don't pay the capital gains? Typically, you get an appraisal. So it's not required, by the way, in the tax code to get an appraisal. It's quite all right to go to the county assessor's website and use the assessed value for the basis of the property, and then use comparables as today's value. Good question.
Thank you. Well, why don't we open it up? If you have a question and you'd like to jump in there, just unmute yourself. You can do that. And we'll have a free-for-all here.
Okay.
Is the estate tax, is it a state by state deal or is it a federal deal? Just one?
Great question. The estate tax is federal. Some states have what is called an inheritance tax, which is an estate tax, only at the state level. Colorado did away with their inheritance tax way back in 1984, I think it was. Maybe it's 1980. Most states, I think there's only about 8 or maybe 12 states that have a separate inheritance tax in addition to the federal estate tax. More questions?
What did you talk about earlier? A cash out option of some kind? You mentioned this new cash out option where you don't pay capital gains.
Well, okay, so you might be referring to two different things. When you look at the new proposed changes to capital gains tax rates, anybody earning from 0 up to 80,000, currently capital gains are 0 for them. Is that what you're talking about?
No. Anyway, it was something that you mentioned earlier really quickly through one of your slides of things you would cover.
Oh. When you do an exchange, I'm going to use my hands here in motion so maybe you can see them. You sell one property, do an exchange, maybe do 2 exchanges, maybe done 12 of them. Someday on the last piece of property, you're going to end up paying the capital gains taxes. Unless you die. If they keep the step up in basis, then capital gains goes away, they're eliminated. But there's another tax-free solution. You can move into your last replacement property in an exchange, turn it into your home, and then someday when you sell it, you can get some, not all, but you can get some of your capital gains out tax-free. In other words, you've taken the deferred gain and turned it into tax-free dollars. And if you want more about that, please call me or shoot me an email. I have bullet points that you can read on how to do that tax-free exit strategy out of 1031s without having to die.
Okay, thank you.
Yes, shoot me an email. More
Tracy,
questions? Yes, ma'am.
I would like to know, can we identify a replacement property before we get the relinquished property on the market?
Sure you can. Absolutely. You can put earnest money down on it. You can go under contract on it. Just don't close on the purchase before you've closed on the sale of the old property.
Okay,
Yeah.
thank you.
You bet. More questions, folks?
Tracy, will you be able to pull information from the chat box about for the folks that are requesting slides, or would you prefer them to email you directly?
If you guys can, why don't you email me directly? Otherwise, I think we're going to run out of time. I think the Zoom platform shuts off in 3 or 4 minutes. I won't be able to write down everybody's email address. Please give me, so let me just make sure I'll type it. Or did you already type my?
I put it in the chat, and there it is.
Thank
Right
you.
there on the screen for people.
Oh,
Right
excellent.
behind you.
Yes, that's right.
Tracy.Wilson. Don't forget the E in his first name.
True.
IPX1031.com. And if something happens, you don't get slides, keep my email, my contact information, and I'll get them to you if somehow you miss. I'm going to put that in there right now.
Again, folks, any questions? We still have 2 or 3 minutes before Zoom shuts us off. Any question?
I have one question.
Yes.
So primary residence, you cannot do a 1031 on.
True. But let me give you some different scenarios. You sell your home, you're going to get your 250 or 500,000 tax free. That's a different part of the tax code. Great. But what if you lived in your house and then you moved out and you rented the old house out a year or two, and then you sell it? Good news, you still get to use your personal home exclusion, but because you've been renting it out for a year or two, you are able to also do a 1031 exchange on any gain above your exempted threshold amount. Yay. That and one other thing, there's a brand new part of the tax code, section 1400Z, opportunity zones. If you're dealing with clients that are wealthier and they're selling a property and their gain is more than 500 grand, they can defer the remaining gain using opportunity zones. Call me and I'll walk you through it. Anybody else?
Well, hold on. Let me rephrase that question. So I have some friends, actually, known them for 30 years. Their house burnt down last year, not completely burnt down, but between water and blah, 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 they haven't lived in the house since last January. They're moving back in this week. And they really, really enjoy living in town. Their house is 12 miles outside of town, which isn't that far, but it is a big difference. So they want to sell that and buy another place. Is there any way to help them so they're not paying capital gains on their house?
Yeah, they've lived there more than 2 years, haven't they?
Oh, yeah.
So it'll be tax-free up to 500,000.
Okay. So as long as, if it's over 500, it won't be?
If it's over 500,000, the amount of the gain above the $500,000 limit will be subject to capital gains unless they invest in an opportunity zone or unless they do a 1031 exchange on that portion.
Perfect. All right. Well, thank you very much.
You bet. Keith, call me for more details. I want to make sure you weren't rushed.
You got it. I will be in touch.
Okay. Anybody else? Any last thoughts about all this proposed tax changes? All right.
Okay.
Okay. So thank you very much.
Just want to say thanks again to everybody. Tracey, awesome information. And thanks to Kara at Keller Williams Urban Elite for hosting us also. We really appreciate that. You all don't hesitate to reach out if you have any questions about 1031s with Tracey or title insurance to me. You all have a great rest of the week. Be safe. See you, Tracey.
Bye-bye.
Thank you.
Jim, appreciate it very much. Bye-bye.
Bye.